I'm 92.90, 10 by 10. Yours.
Mine.
99 at the book. Welcome to the OpenYield Markets Podcast with your host, Mark Hebert.
All right, welcome to another episode of OpenYield Markets with Mark. And today it's actually Open Yields with Mark and Mark. Mark Rieder is joining us this afternoon to talk all things tariffs, Trump, credit, and other things market, and a little bit about his book. Mark Rieder is a MBA from Stern, CFA charter holder who has an illustrious career here on credit. He started at Goldman Sachs with a few stints along the way before leading government of Singapore. GIC is the acronym around the street for them in their high yield and investment grade strategies for a decade plus, and now is currently the CIO at LaMar Assets. So I am pretty excited to have him on the show today. And, you know, as I coin every guest, as you can see here, we have the Reminiscences of a Bond Operator, a play on a very famous academic work, Reminiscences of a Stock Operator. Mark has penned this book, and we will talk a little bit about that later. But today we have the Ernest Hemingway of credit on the show. So, Mark, thanks for being here. I really appreciate you coming.
Well, thanks for having me, Mark. And, most people don't know that we've probably known each other for about 10 to 15 years. I think we started trading together in 2008. And for a long time, we did a monthly call to share our views with each other. And I always really appreciated your perspective. On the trading side, not always the easiest the person to trade with, candidly. If you liked a credit, I generally liked it as well. And, I couldn't take you short and vice versa. And so, but we did do some great trades together. And, I look forward to the conversation today.
You know, what you get on these podcasts is just pure honesty. He is right. We actually had these monthly calls and we talked all things credit, ideas. We were sometimes contrarian, sometimes we were consensus, but we were always very thoughtful about the markets and credit. And I think it helped us both over our career. So yeah, I really do miss those calls, and hopefully today will be something like that. So let's get a little bit into it because as we're speaking, the market is in free fall. We were up 5% at noon. We're down 0.5% now. And over the last couple of weeks, we've just had this amazing macro volatility come in on the back of tariffs, which, have been alluded to for months now. But now that we are finally here and tariffs are actually upon us, we're starting to get this free fall. So you mentioned in one of your notes, and for those of you who don't follow Mark, he is a very thoughtful poster on LinkedIn and other channels, that you said this feels a little bit like the GFC all over again. I'm wondering what you see as parallels that are happening now to the GFC, or what you think could be a little different this time.
Yeah, thanks, Mark. And, candidly, when I'm thinking about the markets all weekend long and, thinking about what I'm going to write on a Sunday for what's going to happen on a Monday, that felt a lot like the global financial crisis. That felt like, when I was waiting, there were research calls and conversations that were happening all the time because everybody was trying to think about what was going to happen. But you also had a situation where the VIX spiked above 50, and that hasn't happened too many times. So felt a lot like the GFC all over again. However, this is different, right? The GFC was caused by maybe banks, some greed. This is different because this is a man-made disaster, right? Banks here are just the victims, So I think there's a big difference here about what's going on.
So to catch everybody up, obviously we have this situation where the president, in terms of what Mark's saying, a man-made situation, we have the president who's basically levying tariffs on the entire world, right? So what we've seen in credit is dramatic spread widening, and some have argued all year, including Mark actually, that spreads have been, complacently tight. And so we've seen this kind of shock value and shock move wider. Where do you think this plays out in terms of leveling off, or do you think this is just the beginning of the unknown?
Yeah. And, I was really grateful today that somebody wrote in on my post this morning that I had said spreads were really tight. And what do we do from here, right? Because the past is the past. The present, we're trying to figure out what's going on. What is the future? And I think the big, challenge here is trying to figure out what's going to go on with these tariffs. But it's not just the tariffs, right? Because you've had a number of events that I'll call it over the last, few weeks, months. First, you had DeepSeek, right? Everybody was bullish equities. Multiples were approaching, 25 times on the S&P 500. And then, following that, you get the Doge spending, government spending cuts. People are concerned about job loss. People are concerned about, spending cuts. And, candidly, when you have stimulus in the market, which you had under the prior administration, that leads to additional spending, animal spirits, and it has a multiplier effect in the economy. The same thing happens when you take away the stimulus, when you take away the government spending, and when you have potential job loss. And so I think that was also, another chink in the armor. Um, then you throw on top of that the tariffs and the uncertainty with the price increases there. I think most people came into the Trump presidency very bullish. They were thinking, here is a president that is going to deregulate. He's going to cut taxes. Those things may still happen yet, but instead, what he's done is he's led with tariffs and spending cuts, right? So this is a big challenge that the market faces that they hadn't thought about, because in their minds they were going to see an unfreezing of the M&A. They were going to see PE deals start to happen again. They were going to start to they were going to see equities continue to rise, and that's not what's happened here.
Yeah, I mean, you could actually argue that some of the capital that's been sitting on the sidelines at PE shops, private credit shops, was meant to be spent in the first quarter, second quarter, to your point on freezing. And if anything, it's actually, melting away. So, the thing is, from November to January, we ran up in S&P about 10%, right? From election day to somewhere in January. And since then, I believe peak is around 6,200 in S&P. And as we speak here today, we're sub 5,000.
Right.
So with all these things in play, and maybe Trump has a long game, right? Maybe there's a medium game to this. It would be hard to think that he would just kibosh this market, on a whim without some real thought behind it. Maybe there wasn't enough thought about it. But what's the level? I've seen a few reports come out say, all right, 14 times S&P is probably the floor.
Yeah.
Okay. If that's the case, we still have another 25% correction to go. Do you think, do we get to some levels like that? Because a lot of times the stock market overdoes it and the credit markets catch up. And what's happening this morning, even when stocks dropped 5%, credit was still, 3 to 5 wider, call it. And it slowly started to catch a bit, and now it's obviously disintegrated. So I guess the question is, what do you think the end game is here for the administration? Do you think it is the U.S. in a voting bloc versus China? Do you think to me, it's get the U.S. In a voting bloc, solve the Eurozone, and maybe there's a longer term war with China, trade war with China. And that's kind of the end game for me. What do you think?
Yeah, look, I think that, I'm no expert in the S&P 500 and, what, the right multiple and what the right, earnings per share is, but I have some thoughts on it.
Yeah.
And, candidly, I like to think long term. I like to think, what is going to happen from here, not today, tomorrow, but what is the long term plan? And so when you look at what's going on, you say, okay, tariffs are short-term inflationary. Okay. That means that already stretched consumers whose sentiment is already low are stretched and they can't spend further, or they're going to have to cut back on something else. Okay. Then on top of that, you've got these government spending cuts, right? Which are also, potentially cause a growth slowdown. So you've got, a double whammy here that's impacting earnings potentially going forward. And so tariffs, companies aren't going to be able to push through all of the price increases. There's going to be margin pressure. And so when you look at the consensus forecast for EPS for this year, next year, I look at TNI, ERNANA, or whatever you look at, and you look at where that is, and then you throw a normal multiple on it. Historically, that's 18 times the last, is it lower than that? Markets tend to overshoot. So you could have earnings come down, multiples contract, and you could see equities sell off further from here. my opinion, maybe it's a 250 times a 16, 18 multiple. Do you get through 4,500? Larry Fink talked about this at the Economic Club of New York yesterday. He's much smarter than me, and he said equities could fall another 20%. That scared the pants off me, right? But it's possible. So
okay, so let's take that conversation, pivot it to credit. Like, where do you think high yield and IG can go? What are backstops or levels in your mind where you start to say, okay, I get for a patient investor, I could start getting comfortable in credit at these levels. So, I believe we came in today with the investment grade index trading around 120, and the high yield, you could tell me, but what are levels or in the back of your mind saying, okay, I wouldn't mind putting some money to work at X, Y, and Z.
Yeah.
If I haven't put money to work already.
So, just a thought that occurred, and Powell said this much more eloquently on Friday. People have thought there would be a Fed put or a Trump put, and Powell said, well, actually, we could see inflation and slowing growth. We're kind of constrained here. That's concerning, right? The question about President Trump, and you saw this huge relief rally yesterday in equities on a rumor that that there would be a pause.
Yep.
It turned out to be not true. In his press release, in his press conference later in the day, he said it's not true.
Yep.
And he's stuck to his guns. Candidly, in my opinion, Trump likes a deal. He likes a negotiation. He likes to talk about talks. And if he backtracks on this, he will lose all credibility.
Yeah.
And so therefore, as the backdrop, he is only going to continue to escalate. And you continue to see that, right?
Yeah.
So the tariffs go in effect midnight tonight. And, if China says, well, we're going to retaliate, then he's going to retaliate, and until the point where there's just maximum pain.
Yeah.
And I think that we don't know how this is all going to shake out. In terms of, credit spreads, I think, look, when February, earlier this year, when you saw high yield credit spreads at 250 some odd basis points, the second percentile of what they've been historically over a 30-year period, you had to say to yourself, upside downside doesn't make sense.
Yep.
Okay, and I'm going to geek out for just like a second here and do some.
Please, we love to geek out here. Most people in the startup world, by the way, are what we call geeks. Like, they're all MIT, Harvard people.
Okay.
So we actually enjoy that here.
Okay. So this is not going to be that geeky, but just some basic bond math, right? If spreads are in high yield are 250 basis points and, call it a 3-year duration. If spreads tighten 2 basis points and they're at the historical lows, like 2, times 3 is 6, you're going to lose 6 basis points and a little bit of carry. Like, you're better off throwing your money in T-bills.
That's right.
Right. And bringing down your risk, or as we suggested, hedging, staying out of the market, shorting outright. So now, though, when you look at spreads and they're 250 basis points, more or less wider,
right,
than the 250 that they were, getting closer to 500, whatever. They're 450 or whatever. But look, 250 times 3, you're 7.5% down on an excess spread environment. And, that is not an awful entry point for someone to start getting involved in credit. If you were short, if you were hedged, if you used limited capacity back when spreads are really tight, then when they're at average levels that they've been at over the last 30 years, that's not a bad time to invest. And, considering that you can shape your duration however you want, and you can get some front end yield, use 3-month T-bills, put on, use interest rate futures to bring back your high yield, durations and throw on things that you like. Well, I think it makes sense to do so. That doesn't mean that there's not further drawdown from here, but I do like it better. And my philosophy and the way that I have always invested has been, when spreads are tight, and I talk about this in the book. Yep. It's a time where you want to pull back. When spreads are average, it's a time where you want to go into the market. And when spreads really dislocate, that's when you want to add leverage. The mistake that most investors make is that when high yield spreads are 250 basis points, they're going down in capital structure, they're going out in duration, they're going down in structure, yep, and they're trying to earn to get that bonus, to earn their extra 10 or 20 basis points to show. And it's the wrong time to do those things. And so those asset managers become impaired. And that's what causes, these dislocations to happen. And that's when you have the proverbial, baby thrown out with the bathwater. And my view is always to be a liquidity provider in those situations to people who, are trying to sell because they're for sellers. They're selling because they have to, not because they want to. And that's a great time. Or we call it, people throw out the baby with the bathwater, and we're here to catch babies.
Yeah, it's like I in 2024, I started to have these conversations with people. I'm like, listen, you're at a point now where the multiple is approaching 25 times in stocks, and I was like, if you're looking at interest rates, and let's just say you can buy bills plus or minus 4%, right? You can buy treasuries in the low fours. You can buy IG in the 5.5–6% range, and it started to compress down to that 5.25–5.5 range. You can buy high yields, sadly, at around 6.5–7%. Yep. I'm like, to invest in the stock market right now, I need 15–20% safe return at these levels, or else I should be going up in cap structure, not down in cap structure. So to your point, what happens is people chase returns and end up squeezing the juice out of a moldy orange, right? And then you end up having this situation where the people who are selling are the people who got caught off sides. And if you want to be in a position of strength, not weakness, you want to be the person who can actually say, okay, at this level, I would take some bonds. Well, it doesn't mean I'm leveraging up yet, but at least at this level, if you want to sell them, I'm here for you. I'll be your liquidity, but it's going to be at a level where I'm getting paid for commensurate risk.
Look, I think the right time to take leverage is when everybody's running around with their hair on fire.
That's right.
Not at the tights of the market, and that's the mistake that most people make. I will tell you, and this is a funny story. And look, there were some warning signs, right? Warren Buffett all of a sudden, announced that he's holding record levels of cash. Nobody paid attention to that. I was at the high yield conference, JP Morgan, and Jamie Dimon said, I wouldn't buy credit spreads here for anything. I wrote about that in a LinkedIn post. And, right. I mean, these are important signals, but I'll tell you what was the most craziest thing. And, when I was at NYU getting my MBA, I had a professor who said that he had gotten into a cab, and the taxi driver was asking him for tips. Yep. on equities. And he said,
he wasn't asking him for tips, like to get out of the cab?
Yeah, both, right? But he was, they were talking about stock tips. And his point was, this is a market top. This is when everybody is, talking about stocks, it's a time to sell. And, it goes back to the old, shoe shine boy, right? If the guy who's shining your shoes, says, what is talking about stocks, like in your stock tips, it's a time to sell. Well, the exact opposite happened to me. Candidly, I didn't know what to do with this, but I got into my Uber going back to Miami Airport, and my Uber driver starts to tell me, now this is after I was at a conference where everybody was bulled up. Spreads were tight and going tighter.
Right.
And I was like, this is a little crazy. My Uber driver says all the reasons why he's selling equities are going to go down, and why Bitcoin is going to go down, and why President Trump doesn't care about the equity markets like everybody thinks that he does. And I was like, wow. Okay, what do I do with this? Uber driver is telling me that he is getting out of the market, and all of these professionals are saying, that was just like the perfect sense.
Well, the ecosystem changed too. These Uber drivers spend so much time in the car that they're listening to CNBC all the time. So, they hear the pundits and the Kramers of the world telling you not what to do. I think you're right though, right? The point of extreme and the point of complacency. And to me, I look at it from not just equities, but in credit. The amount of money that's going passively into ETFs, into funds, has just changed dramatically over the last 10 or 15 years. So the active investor has turned into let's just say a Vanguard fund that charges almost nothing, but they're going to just take your money and put it into X, Y, and Z. Every month, you're going to allocate some of your paycheck into one of these passive funds. And what happens is when everything's rosy, nothing's happening, you get this slow drift up, right? And you feel really good about it. However, when something like this happens, and all of a sudden all this passive money, well, eventually, people are going to get their statements, right? The first quarter just ended. You're going to get your quarterly statement. The shockwave of March has started, but now you're going to be at least looking at your statements and, okay, I'm down, let's just say 5% or something of that nature. And realistically, now you look at the market like, oh, I'm actually down like 15 or 20%. Then you might get the second wave of, I'm scared, to your point, and now I'm a retail investor and it's time for me to get out. And usually what Mark just was saying is The last person to sell is mom and pop. The last person to buy is mom and pop, because unfortunately, technology has still allowed for us to get statements later on in life than we should, or we're maybe not monitoring things like we should be. So that's a lot to talk about, which is really important.
Well, let me bring that up just for a second, because right now, even though we've seen a pullback, it seems to be a little bit orderly.
Yeah.
Okay. It's so far.
Yeah.
And I think that, to your point, there's been a wall of money that continues to come in biweekly or weekly into 401ks that causes, but, we've seen people, buy ETF in credit portfolio trades, not care about what they own. And for me, I love that, because, candidly, you have the ability then to pick and choose, because all credits go up together and they all go down together. And so therefore, if you're doing your fundamental credit work, then you can figure out, something is rich, something is cheap. What can you go long? What can you short? And it provides a great opportunity.
So I guess just to that point, like, what are some sectors or areas that you would like or favor over others right now, or parts of the curve, double Bs versus triple Cs, or, up in quality into IG? Like, what are some sectors or themes that you're looking at right now in terms of investment?
Yeah. So I always like to look at the top node. What should I be doing? Where are we headed? Then from there, to your point, which sectors, which areas, and then what specific companies. It's sort of where you take a top-down approach, but a bottoms-up as well. Right now, I'm really concerned about the consumer.
Yeah.
I'm concerned about retail.
Yeah.
I'm concerned about travel and leisure.
Yeah.
On the other end of the spectrum, I still think that there's going to be demand for electricity and with AI and data centers that supports some of the utilities. I think that in the energy space, you may not like oil, but natural gas is still nearly double what it was just a year ago, right? And by the way, just because the travel and leisure sector, the airlines, I mean, American Airlines CDS is gapped out to 800 or 900 basis points, right? So if you think that they can delever, I'm not saying that they can, but they have deleverage, right? People just use that as a whipping post. And so, I think people need to do their work. So at this point, what you're doing is, if you are really a good, sharp credit team, you should know your companies already, right? How they're going to be impacted by the tariffs, how their costs are going up, what markets they sell into, and whether or not they're going to be impacted by that. If not, you're talking to them. What's your liquidity look like? What are your debt maturities? What's your ability to withstand this? And that allows you to get, this is, what I started to allude to the other day, the tariff playbook, which was and then one of those posts that again once went, viral. And that's where you start to make the playbook of investing correctly in the good companies. So top down, yes. At average spread levels, you do okay. At wider spread levels, you do even better. The work that I've done shows that, if you get into the fourth quartile of spread ranges, it's in the book. Yeah. The forward excess returns over the next year are generally, 6-7%. You throw that on, just excess returns, throw that onto a 3-month T-bill, and by the way, it could be even better than that, and your credit selection really matters.
So to that point, what I'm getting from that too is, you look at American Airlines, the equity cushion is almost gone. Right? Yeah. The equity has been halved in the last 3 months. It really started with Delta Airlines coming out and saying, "Hey, stuff is a little weaker than we thought." Right? I believe the CEO's name is Ed Bastian. He came out in February and said, "Hey, watch out, the consumer's not spending money. We're cooked." All right. And American Airlines, I believe, went from 17 to 8. And to your point, they have a lot of debt.
Yeah.
Right? American Airlines is sitting on a lot of debt, and the equity cushion's gone. Do you think that, because I do, remember in the regional bank crisis of a few years ago, a few people couldn't make it really because of time. Right. And we had this stress scenario where everything just kind of overshoots to the downside, and a few people ran out of capital. You'll hear the story, Silvergate, Silicon Valley, the First Republic, all these companies. Industrial small caps and high yield, I feel like we're going to see the defaults tick up, right? Default rate has been historically low over the last 5-6 years since COVID, really. What do you think about small cap, high yield right now? Completely stay away or really do your work?
Great question. And by the way, over my long career, and I've got a little gray hair, I've seen the autos, home builders, the banks, the regional banks, the energy sector all go through cycles. And so, when it comes to looking at something airlines, and I don't want everybody to run out and say, "Oh, Mark said do this," because I did not. But in those cases, sometimes when oil prices going down, maybe you don't look at the energy company. When airlines are coming down, maybe you look at the air lessors who own the collateral, who own the planes.
Yeah.
Okay, and that may be a real opportunity.
Yeah.
As far as lower quality, high yield, I think that there's something really interesting here that you bring up. And the high yield market has been kind of stuck at 1.3 trillion. Okay. Um, when you look at the constituency, double Bs have grown to 52%. It's, nearing, not at a high, but near a high. Triple Cs are down to like 10%, 11% of the index. And so they've become a smaller portion.
Yeah.
Where has all of that lending gone? You're smiling.
I mean, to your point, I mean, you're making an argument that maybe the high yield index has taken a leverage down net, right?
It has. Look, I think using some numbers from Bloomberg, net debt to EBITDA was like 3.8 times or something like that for the high yield market in 4Q. Will go higher, but my concern is that where has all the money gone? A lot of it's gone into private credit. A lot of it's gone into middle market lending. It has a place. The banks pulled back from this. I talk about this in the book a little bit. The banks pulled back. It's great that others stepped in. I like the diversity of funding, but what is the concern? When you're leveraging plumbers, electricians 7 to 8 times, and all of a sudden there's some economic challenges where consumers are stretched. Are they going to be spent? And I'll make a stupid example here, but like it used to cost me $150 to service my generator. They got rolled up into somebody else, and now I've got 2 people standing over it. They don't exactly know what they're doing, and they charge me $450. That's just. I think that there's been inflation there. That's hurt the consumer, and so will people be able to afford these increased prices? Will these businesses do well in what is turning out to be potentially a high rate environment, stagflation, slow growth, companies that were leveraged in good times 6 times.
Yep.
And so when you look at the triple Cs, there are many private, if private credit on average is 6 times levered, that is what triple Cs are. And most people are saying, well, let's back up the truck. We love this. The price doesn't move, and we'll just, we'll clip an extra return. And I don't think that when you step back and you look on a risk adjusted basis, that you might be getting compensated for that risk. And so to answer your original question, I think that, the loan market is a little more levered than the high yield market, and the private credit is a lot more levered. And I think you could see some private credit asset managers fail.
Right.
And maybe that's blasphemous, but I think that the challenge is, and how does that manifest? In multiple ways, right? You've got banks lending on secured lending, right? This is, and will they pull back? BDCs, defaults. Right, you could see an increase in defaults, and if a tree falls in the forest and nobody's there to hear it, which is their argument, we can restructure. But the challenge is, what do you actually own at the end of the day?
Yeah, I mean, all this money going into private credit. Let's be honest. What's the mark to market on all this stuff? Right, we've had this big shock and all this on the asset classes that we can have some sort of value to. What's the mark to market on all this private credit? Right, what's the pitch now if you're raising a fund in private credit? It's going to get harder. And I'll also say, a couple of weeks ago, Apollo came out and said, hey, we're going to try to make a secondary market in private credit. And everybody was like, oh, that's a novel idea. And I actually said, oh, that is a novel idea. And then behind that, I said, that's a problem because they're really worried in general about how illiquid the product is right now. And somebody in some room is like, wait a minute, we don't even know where this stuff is. We should create some sort of a liquid vehicle so we have a pulse, and maybe we can, try to trade around a little bit and get out of some of the stuff. That's the cynic in me. I'm like, everybody's talking about the boom in private credit. The long bond sold at 4 points yesterday, and the market's shocked down 20%. And you're sitting on assets that the liquidity is probably at least 50% less than anything in public markets. It could be the next little swoon when you start hearing private credit managers fail, or inability to raise funds, even though they're sitting on capital. So I think that's kind of an interesting point. So we talked a little bit about the Fed, and I just want to talk a little bit more about the Fed, and maybe you'll have the same answer, but it seems to me like, our good old pal Jerome is in a corner, right? Trump has kind of put him in a corner. Trump has got oil lower. Until 2 days ago, he had interest rates drastically lower. But with tariffs, Powell's holding a line in the sand. So, I saw an image yesterday of people thought Powell's going to be able to land this plane softly. And now he's got this new initiative where if tariffs are short-term inflationary and we're in a situation where we are with no growth and maybe a uptake in inflation, what on earth is the Fed going to do? Like you look at everybody's modeling 3 to 4 cuts now, and the Fed is pretty steadfast in saying like, we're not in a position to cut. So, and maybe there'll be an emergency cut. And if that's the case, that's a real problem. But it feels to me like Jerome is in a real pickle here. What do you think about that?
Well, actually, I think who's in a real pickle is the Treasury Secretary. But look, I think the Fed has done an okay or pretty good job at navigating. They were a little bit behind on the inflation that they said was transitory, turned out not to be. But we're in a different regime. There's potentially stagflation ahead. And that makes it very difficult for Powell to lower rates.
That's right.
If inflation is in fact going up. What's more challenging is for the U.S., who has to issue a tremendous amount of debt to not only fund its deficit, but to fund all of the upcoming maturities. I'm looking very forward to the report, the quarterly report that comes out on April 11th that talks about, where the Treasury is at. But, it shouldn't be too much of a surprise because in the last report, they had, close to $10 trillion of short-term, maturities that they needed to come to market with, in addition to, what's, $1 to $2 trillion of deficit spend. And, that's a wall of issuance. And who is going to buy this when you're in a war with everybody, a trade war with everybody? There's a concern that there could be a potential buyer strike. And so I don't know whether that's because people fear inflation, because the demand is going to exceed the supply or whatnot, but you're seeing that manifest in the Treasury market, where you saw a 32 basis point intraday swing in the 10-year Treasury yesterday, which, in my memory, I don't remember happening. But,
it's a 10% move in 4 hours in the U.S. Treasury, if you think about it that way, on a security that's yielding 4%.
So, if I think that, the next legs, the things that concern me are that, just like the GFC, we start to see, people buy the dip, then they realize they get their heads chopped off, and then they sell, and then it just keeps on. There's a negative feedback loop.
Yep.
The same thing with the U.S. Treasury market and the amount of debt that we have to issue. I've always been concerned about a buyer strike, and I'm not saying that we're there, but it's certainly concerning when you see a move like that.
Yeah, 100%. 100%. And it's a, you call it the wall. I call it, the wall of worry. To me, it's the wall of worry. And it will be very interesting to see what plays out over the next couple months with the Fed and Trump and the back and forth between the administration and the Fed.
The one thing I'll say, Mark, and I forgot to say this earlier, is that, the thing that concerns me, and I mentioned private credit, but unfortunately, that outlet that people have is liquid credit. And a lot of times people will sell what they can, not what they want to. And so that's where you could see pressure, even though fundamentals are in good shape.
Yeah, a lot of people actually look at their portfolio and they sell what's up, right? Because they're up on it. And psychologically, they're like, oh, I'm up 3% on NVIDIA, let's just say. Let me just sell that. And then the rest of their portfolios were all the let's just say the garbages, the doggy do. And that's the stuff you're probably supposed to sell, even though it feels worse. And people always make these psychological decisions based on, whether they're up or down. So, and it gets to this problem where eventually, in this really weird way, when you can't take any more pain on the loss, you finally sell it. And that's the time where you're probably supposed to hang on to it. And that's just the way of the market. That's the Warren Buffett, solvency and time, conundrum. So, I got a couple more questions before we wrap up here, if you don't mind.
Yeah.
And what would be something that would make you fervently bullish? Let's just say what would change to make you fervently bullish at either a certain amount of level, and we can obviously talk credit because that's what we're here to talk about. Where you just say, hey, I gun to my head, I have to buy this, or policies change, we're in the clear, everything's okay. Is it everybody but China? Is it everybody? Is it just a de-escalation in general? Like, what gives you the green light from right now? It seems like you're between a red and a yellow light.
Yeah. Look, I still think,
And by the way, it's okay. You can say you can be a yellow light forever. That's okay. You can still, drive through a yellow light. Just you have to be very cautious.
so if there's some deal that comes in, something that happens, obviously that's going to be a big signal. The challenge is that nobody rings a bell at the top or the bottom of the market. And so unfortunately, and this harkens back to previous experiences that I've had, which are you need to be buying when everybody else is selling. Because if something momentous happens, if there's a change, then all of a sudden it's going to be very hard to buy risk.
You almost saw that yesterday,
Yeah,
right? So if that headline was true, let's just say that headline actually was true, that we were going to delay for 90 days. To your point, you lost out on 6% in 30 minutes, right? You lost out on, let's say 1/3 of the move lower in 20 minutes.
Markets move very fast.
Yeah.
And so unfortunately, I think that, what you need to do here is know your credits, know your sectors, know the companies, buy what you like, buy what's on sale. As spreads move wider, you continue to add to your risk. Yes, you potentially may suffer drawdown. That's having the right partners, the right investors who are there, who say, you know what, this is the right thing to do. Because ultimately, if spreads get out to 750, well, when they go back to 250, you're going to be really happy that you had those 500 basis points and equity-like returns in your credit portfolio. So that's what I'm, so waiting for the event and the catalyst. That being said, I do think that while Trump is going to dig in his heels here a little bit so that he has the credibility, he's got the midterm elections next year. He's got the 250th anniversary of the U.S. Centennial, whatever it is. Yeah. And he's going to need to show progress at some point. So I think that, this is why I feel that, while people are running around with their hair on fire, it makes sense to start getting involved, because you will see potentially something on taxes. You will see something on deregulation, and you may see some partners come to the table to do deals. And by that time, it might be too late. And so I think that that's a contrarian view where people are just looking at today and not thinking about, tomorrow, 6 months from now.
Yeah. So buy what's on sale. I always like to say buy what's on clearance, but not getting discontinued. Right? Buy what's on clearance, not getting discontinued. You don't want to buy that pair of shoes they're never making again.
You don't want to be impaired.
You don't want to be impaired. But buy what's on sale. Do your work. It always pays to do your work. I was actually, a quick anecdote. I actually was talking to my mother and I'm like, have a plan. She's like, oh, should I be buying this dip? And I'm like, have a plan. If X happens, Y happens. That way you're not stressed. I mean, she's in her 70s. That way you're not stressed about everything. But if you want to buy some high quality dividend pairs at these levels, like, go ahead. But just understand that it's not for tomorrow. You're not buying it for tomorrow, right? You're buying it because it's on sale, and hopefully it's not on sale in a year from now. So let's just finish off real quick. You've done a lot of work on this book. Listen, Mark Rieder has been in the credit markets for a long time, and he's been a very senior portfolio manager and market leader and voice, as we've learned here over the last 35, 40 minutes or whatever it's been. But give me a little bit of a lens into your book and what it's about and what you think people will get out of it.
Well, first of all, I've always enjoyed teaching, and I was taught how to teach way back early in my career. I had some classes, and they taught me that you don't just lecture. You ask people questions and you make them think. And that's what I tried to do with this book. And so my vision, and at one point I had hoped to actually teach an undergraduate or graduate level class.
Yeah.
And so I created a syllabus and I wrote the book to the syllabus. Okay. So, you've got 60,000 hours of my experience plus embedded in that book. Um, but also, look, people don't know me.
Right.
I've been tucked away at the sovereign fund for a decade,
Yep.
tucked away somewhere else for 10 years prior to that. And, if you're Goldman Sachs, Morgan Stanley, JP Morgan, Bank of America, Citi, my friends at Truist or TD, like, Mark Rieder, but not one allocator, not one insurance company, endowment, pension, other sovereign knows who I am. And this was a way for me to say, hey, I know what I'm doing in credit. We know what we're doing in credit. And so I was really excited to be able to share that. And, you know, what's been amazing to me, Mark, is that people have, private messaged me, written to me, told me in person how much they love the book, that they've given it to their colleagues, they've given it to the juniors on their desk, they've even given it to their children to understand the markets. And, this was a huge passion project for me. This was my, the working title was A Practitioner's Guide to Investing in Credit. I wanted to give it a little bit more moxie. So, we use something, a little bit more interesting title. But I mean, the reviews have been fantastic.
Yeah.
I could even read you some of the reviews. They're all on Amazon. But it's just heartfelt for me to get the amazing level of feedback that I've gotten. And, candidly, there's an industry titan who is currently reviewing the book, and I've gotten a preview. They've told me they think it's excellent.
Great.
And I'm hoping that comes out soon, and that just adds to the legitimacy of people understanding my views.
Well, listen, you can hear his passion come through his voice about this book. And I always say, when I was hiring employees for 20 years, ambition, passion, and a general acumen can make a really successful human being. But the passion alone is really incredible. I was actually speaking to a client this morning, and he said, "Hey, I saw you put out a little teaser about your podcast." He's like, "I'm actually reading the book right now. It's tremendous." So I was like, "Oh, that's a great use case just to tell you about in person." So, people are listening, people are watching, and hopefully after this podcast, maybe a few people will go pick up a copy. Listen, I really appreciate your time. This is the Ernest Hemingway of credit, and we're really happy that you're here. And live from Studio A, this is OpenYield Markets with Mark, and today it's Mark and Markets. Take care, everybody.
Thank you, Mark.
Yeah, absolutely.